Hi, everyone. Welcome back to Seven Figures. If you've been watching this channel, then you know that the goal of the channel is to evaluate the three investment philosophies. First one is a dividend income portfolio. The second one that I'll cover is the growth portfolio. The third one is the Boglehead portfolio, which is ultra conservative. Today we're going to have a very short video because I'm just going to give you an update on the performance of all three portfolios and highlight one of the risks that's in the growth portfolio that both helps the portfolio but also could hinder the portfolio, which is the really fast growth coming from single stock risk. But starting off today, you can look at we're looking at the dividend income portfolio. This portfolio has around 60 total stocks, covering everything that the S&P 500 may have in terms of the indices. So you have the financials. I have some bonds here, utilities, healthcare, technology, energy, consumer discretionary, industrials, consumer staples, REITs, alternatives, and communication. When I get some time, I'll actually go through all these individual slices and show you the stocks that I hold in there. But one of the main rules in this portfolio is that every stock has to be dividend paying to be in this portfolio. Year to date, which is basically only 3 weeks since I opened this account, we're up 2.36%. The total between when you look at the earned dividends and also the market gains is $41.92. So $4.93 in earned dividends in this past 3 weeks and $36.99 in market cap growth. So even though it's only 2.36%, really in 3 weeks, that's still pretty good growth. You won't get anything like that in a bank account, in a money market account, and even a 10-year treasury is actually below 2.36%. So nothing to sneeze at, but definitely not anything to be excited about. And I know a lot of dividend investors wouldn't be too happy with the 2.36% growth. But I'm sure as the year goes on, we'll start seeing improved performance, and really we'll be focusing on these returns here, the earned dividends. The next portfolio is the growth portfolio. And when that loads up, I'm going to show you the real difference here. So the growth portfolio is up significantly. It's a smaller portfolio with only 11 stocks. And these are the 11 stocks, which I went through in my last video. Heavily tech weighted because I was looking for stocks that don't pay any type of dividend. And so far, in the last 3 weeks, the portfolio is up 7.8%, $144.91 in market gains. No earned dividends because, again, there aren't any stocks really paying dividends in here except for Microsoft, which pays a very small dividend. This portfolio is doing really, really well. Even though the market has been volatile, a lot of the companies in it are, large companies that are growing rapidly, and even the small companies are growing fast and expected to grow fast in the future. Now I'm going to take you to the last portfolio, which is I refer to as the Bogleheads portfolio. It's a two-fund portfolio because really there are only two ETFs in here. The Vanguard Total World Index Fund, which is right here, and the Vanguard Total Bond Fund, which is covering US bonds, both in the private sector as well as the public sector. So it's a very safe bond portfolio. This one is growing really, really slow, even slower than the payout. The return right now is far below even a 10-year treasury, 0.39%. I expect this to accelerate because 50% of this portfolio is equities. So far, the returns are totaling $7.64, where $1.76 came from dividends of the bond portfolio and market gains of $5.88. So very slow growth. I'm sure this portfolio will do very well when the market becomes more volatile and unbalanced. There'll be very little movement in this portfolio because it's so well balanced. This is kind of following Benjamin Graham's rule of never more than 75% and never less than 25%. So we're staying somewhere in the middle, 50-50 split. Now, one thing I do want to cover before ending this video is the growth portfolio and some of the risks inherent in it. So it's up significantly over the other two portfolios. I mean, doubling, almost tripling the dividend income portfolio. But if you take a look at where a lot of the growth is coming from, out of those 11 stocks, you can see that Beyond Meat, which is doing really, really well. This is the company that's founded on the idea of replacing meat with vegetables, vegetarian meat, so vegan meat. It went public not too long ago. It's up 500% since IPO'd, and it's done extremely well. It's a company that I really do like. I like the idea because I also stopped drinking milk a couple of years ago and switched to almond milk, and I've never really looked back. I think the same thing could happen in the meat area. Is there a bubble in this portfolio? Maybe in this stock actually, maybe, but maybe not, because they also don't have a very large float of shares out there. So there's a scarcity of shares, and there's really high demand. Both people wanted to buy the shares, as well as a high demand from shorts who want to get their hands on the shares so they can short them. I think the company does have a bright future as long as they don't get any major competitor coming after them. And in the short term, it doesn't look like anybody's going to be coming after them in a pure play market. So they do have a long runway. I'm looking forward to them reporting their numbers in a few days coming up here in July. But originally, this was slated to be 11% of my portfolio in the growth portfolio, and it's grown so much that it's 12%. The other company that's contributing significantly to this portfolio is Tesla. It's up 15.29%. And it's supposed to be 15% of my portfolio. It's down to 14.4, but that's mostly due to the fact that Beyond Meat has grown so much faster. Tesla is also slated to report their numbers this week. I think this company has also got a very bright future, and it's contributing 41 of those dollars. So if you look at the total growth here of $146, $100 of that is coming just from Tesla and Beyond Meat, which is really impressive, but also highly risky. Because if these two companies report poor numbers this week, you wouldn't be surprised to see this portfolio collapse and go into the negative, similar to what you see happen to Netflix late last week, early this week, where they reported negative numbers, and they came from being positive to now being negative 21% and easily collapsing. So we'll see. This week will be a big week in terms of determining where we go in terms of the three portfolios and their performance. I have a lot of faith that Tesla will come back with really good numbers. And I also think Beyond Meat has got a really clear runway to keep growing fast and reporting good numbers for the next 2-3 years, or even 5-10 years. But we'll see how it goes. That's it for today's video. If you enjoyed the content, hit a thumbs up so others can find it. And if you loved what you heard, well, please subscribe. Thanks for watching.